Thank you for joining California Capital Financial Development Corporation. We are a community development financial institution offering assistance to small businesses through our Women's Business Center, Procurement Technical Assistance Center, and other lending and technical assistance programs. We provide one-on-one business counseling, business training and workshops, technical assistance, financial education with access to loans and loan guarantees. So thank you again for joining us today. Today, we will review the balance sheet. My name is Sunita Maharaj, and I am a senior loan officer with the California Capital. So what is a balance sheet? It's a financial statement that summarizes a company's assets, liabilities, equity, capital as of any given date. Typically, it is prepared at the end of a set period, monthly, quarterly, or annually. A balance sheet is assets equal to equity plus liabilities. The assets shown on a balance sheet are those items that are owned by the business, which have value and for which money was paid. The liabilities shown on a balance sheet are those amounts that a business owes to other people, businesses, and government agencies. The owner's contributions of capital are the amounts that owners, partners, or shareholders have paid into the business in the form of investment or have reinvested into the business by leaving their profits inside the company. So a balance sheet is a snapshot representing the state of a company's finances, what it owns and owes as of the date the statement was completed. Why is a balance sheet important? A balance sheet is an important financial statement that gives a snapshot of the financial health of your business at a point in time. I want you to know that you will hear the words snapshot and point in time when speaking about balance sheets. Next, we will review some examples of balance sheets. Here is a very simple balance sheet, which I believe most businesses can use. There are assets, and under the assets is cash and inventory. There is liabilities. Under liabilities, there's accounts payable and loans payable. Under owner's equity, there's capital. As you can see, assets equal liabilities plus equity. Here's another balance sheet. I want you to know that the balance sheets can use several categories under their initial headings of assets, liabilities, and equity. Let's take a look at the assets under this statement. Under non-current assets on this sheet, you have land and buildings, furniture, machinery, and investments. These are assets you will have for more than a year under non-current assets. Under current assets are assets you will have for less than 1 year. On this sheet, you have inventory, debtors receivables, which are amounts that customers owe the business. And here you will also have bank and cash. In the case of a small business, not all of these categories will be needed or used. On this example, let's take a look at assets and other assets on the left side. You can see on this example, this company has intangible assets. Now, what's that? Let me give you some examples of intangible assets. There are trademarks, customer lists, and licenses. Trademarks or copyright is a word or symbol that represents a company. Once registered, it cannot be used by another party, but it can be sold by the registrar. Customer lists. Why is it important? For new companies operating in the same sector, this is a gold mine. This information can also be sold. For licenses, such as trading licenses and hiring licenses. What I just went over is only some examples of intangible assets. Now let's take a look at current liabilities. On the right side, we have accrued expenses and deferred revenue. Accrued expenses are expenses a company accounts for when they happen, as opposed to when they are actually invoiced and paid for. Some examples of accrued expenses are interest on a loan, goods received, services received, and wages for employees, which you have not yet received an invoice on. This gives you a better picture of your liabilities and what is owed. We also have deferred revenue under the current liability section. This refers to advance payments a company received for products or services that are to be delivered or performed in the future. I don't want you to get confused or carried away with some of these additional categories because most will not apply to you, but I want to let you see what is possible. If your business gets to this point of accounting, then you should hire a bookkeeper or CPA to guide you through this process. This complex example we show here and what we just reviewed has more categories, but it still has the same headings of assets, liabilities, and equity. Let's take another look back at the simple version we reviewed in the beginning. You see the same information is required here. You don't have to make it complicated to get the information down on paper or an Excel sheet. I can say the key to getting your balance sheet correct is to make sure you are reviewing your business bank statements and invoicing on a weekly basis to make sure the numbers are adding up. Many times I am asked, what is the difference between a balance sheet and profit and loss statement? Typically, the balance sheet is presented as of the last day of the month, quarter, or the company's fiscal year. Investors and lenders use a balance sheet to understand the financial strength of the company, comparing the amount and quality of its assets against its liabilities. Whereas the profit and loss statement shows the income, expenditures, and profitability of a company over a period of time. The balance sheet provides a snapshot of the company's assets and liabilities as of a certain date. This is the end of our presentation. If you would like more information, please go to the website at cacapital.org. You can also find more videos on the website. I hope this information has helped you. Thank you so much for watching today. Take care.